Hey everyone, welcome back to Corporate Decoder. Today, XOS Incorporated just filed a material definitive agreement that is changing how their debt converts, and I am seeing a big shift in potential dilution. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company drastically lowered their debt conversion price, which could mean a lot more shares hitting the market sooner than expected. So, what we have here is a filing from XOS Incorporated, a company that makes electric vehicles. They are reporting on a change to a significant debt agreement they have with a company called Algemai Automotive Company. The main event is that XOS and Algemai have agreed to amend a convertible promissory note. Think of a convertible promissory note as a loan that can be turned into stock later. This note was originally for $20 million and was issued back in August of 2022. This new amendment, called the Third Amended and Restated Convertible Promissory Note, is changing some key terms. And this is where it gets really interesting. The conversion price, which is the price at which this loan can be turned into XO stock, has been slashed from over $71 per S-hair down to just $12. Per S-hair down to just $12 per S-hair. This is a massive reduction. To give you some perspective, if you owned a loan that could be converted into shares at $71.45, it would only be attractive to convert if the stock price was significantly higher than that. But now, with a conversion price of $12, it becomes much more appealing to convert that debt into stock if the stock price is even slightly above $12. This dramatically increases the potential for dilution for existing shareholders, meaning more shares could be issued. On top of that, they've added something called a mandatory conversion feature. This means XOS can force the conversion of the debt into stock if the stock price stays above $16 for about 20 out of every 30 trading days. This is a smart move for the lender, Algemai, as it ensures they can get their convertible debt turned into equity, and it protects them if the stock surges. For XOS, it is a way to get rid of this debt on their books, but again, it points to significant potential future share issuance. This is quite a shift. Historically, when companies drastically lower their debt conversion prices or add mandatory conversion triggers, it can be a sign that they are trying to manage debt obligations ahead of potential future stock price performance. Or perhaps they are facing pressure to convert this debt. It is a tool that can increase the number of shares outstanding, and for current shareholders, that often means their ownership stake gets smaller unless the company's value grows proportionately. This filing includes the actual Third Amended and Restated Convertible Promissory Note as an exhibit. It's always good practice to look at these actual documents though. For today's analysis, we're focusing on the implications of the changed terms. The report is signed off by Liana Pogosian, the Chief Financial Officer of XOS Incorporated. This indicates that the company's financial leadership has approved and is aware of this significant change to their debt structure. Now, looking at this from a broader perspective, XOS is in the electric vehicle space, which is a competitive and capital-intensive industry. Companies in this sector often rely on debt and equity financing to fund their growth, manufacturing, and research and development. A convertible note is a common financial instrument, but the terms here suggest a significant sweetening for the lender Algemai. This move could be interpreted in a few ways. It might allow XOS to secure favorable terms for a substantial loan that is crucial for their operations. However, the drastically reduced conversion price and the mandatory conversion clause mean that existing shareholders should be prepared for potential dilution. If the stock price does indeed rise above $16, that $20 million in debt could be converted into over 1.6 million shares of common stock based on the $12 conversion price. Assuming no further adjustments, that is a substantial number of shares for a company often trading on the edge of major exchanges. We've seen similar moves in the past where companies sweeten terms on convertible notes to ensure financial stability or to incentivize lenders. However, the scale of the conversion price reduction here is the key takeaway. It signals a potential acceleration of equity issuance, which can put pressure on the stock price if the company's performance doesn't keep pace with the increased share count. What I am really watching for is how XOS's operational performance evolves. If they can drive significant revenue growth and improve profitability in line with this potential dilution, then this maneuver might prove to be a necessary step for future expansion. But if the business doesn't pick up the pace, existing shareholders could see their ownership stake significantly diluted without a corresponding increase in company value. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if you found this breakdown valuable, like this video and subscribe for more. Check out our Discord community in the description.